Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Analyzing Cash Flow Statements. Analyzing cash flow statements is a pivotal component of mastering business strategy and cash flow management. The cash flow statement, a cornerstone of financial reporting, offers critical insights into a company's operational efficiency, investment activities, and overall financial health. Understanding how to analyze these statements allows business leaders to make informed decisions that enhance strategic planning and resource allocation. A cash flow statement is divided into three main sections: operating activities, investing activities, and financing activities. Each section provides unique insights into different aspects of a company's financial operations. The operating activities section reflects the cash inflows and outflows directly related to core business operations, such as sales revenue and payments to suppliers. This section is crucial as it indicates whether a company can generate sufficient cash from its regular business activities to sustain its operations. Investing activities encompass transactions involving the purchase and sale of long-term assets and investments. This section reveals how a company allocates its capital towards growth and expansion opportunities. For instance, significant outflows for purchasing new equipment or facilities might indicate a strategic investment in future growth, while inflows from selling assets could suggest divestment or restructuring efforts. The financing activities section outlines cash flows resulting from transactions with the company's owners and creditors. This includes issuing or repurchasing stocks, borrowing or repaying loans, and paying dividends. Analyzing this section helps understand how a company finances its operations and growth, and the balance between debt and equity financing. To delve deeper, consider the importance of cash flow from operating activities. Positive cash flow from operations indicates that a company is generating enough cash to maintain and grow its operations without relying on external funding. It reflects the company's operational health and efficiency in managing its working capital. On the other hand, a negative cash flow from operations might signal underlying problems, such as declining sales or poor expense management, which could jeopardize the company's sustainability. Next, investing activities provide a window into a company's long-term strategic decisions. For example, substantial cash outflows for acquiring new technology or expanding production capacity can be a positive indicator of growth potential. Conversely, continuous cash inflows from selling off assets could suggest that the company is liquidating its resources to cover operational shortfalls or reduce debt, which might raise red flags about its future prospects. Financing activities reveal the company's approach to funding its operations and growth. A balanced mix of debt and equity financing is typically desirable. Excessive reliance on debt can increase financial risk, while too much equity financing may dilute shareholders' value. Analyzing trends in financing activities helps assess the company's financial strategy and risk management. For instance, a company consistently issuing new shares might be diluting ownership, which could impact existing shareholders' returns. Comprehensive analysis of cash flow statements also involves computing various cash flow ratios. Key ratios such as the operating cash flow ratio, free cash flow, and cash flow margin provide deeper insights into a company's liquidity, solvency, and profitability. The operating cash flow ratio, calculated by dividing operating cash flow by current liabilities, measures a company's ability to cover its short-term obligations using cash generated from its core operations. A higher ratio indicates strong liquidity and financial stability. Free cash flow, defined as operating cash flow minus capital expenditures, represents the cash available for distribution to shareholders or reinvestment in the business after accounting for necessary capital investments. Positive free cash flow signals that a company can fund its expansion and reward its shareholders, while negative free cash flow might indicate the need for additional financing or operational improvements. The cash flow margin, calculated by dividing operating cash flow by net sales, measures the efficiency of converting sales into cash. A higher cash flow margin indicates better cash generation from sales, reflecting strong operational performance and effective cost management. This ratio is particularly useful for comparing performance across companies in the same industry. Consider the case of Apple Inc. According to its 2022 annual report, Apple generated $104 billion in operating cash flow, reflecting its robust business model and effective management of receivables, inventory, and payables. The company also invested $11.5 billion in capital expenditures, demonstrating its commitment to innovation and infrastructure development. Additionally, Apple returned $29 billion to shareholders through dividends and share repurchases, showcasing a balanced approach to financing and shareholder value creation. Another example is Tesla Inc. In 2022, Tesla reported $9.2 billion in operating cash flow, driven by strong sales growth and operational efficiencies. The company invested $6.5 billion in capital expenditures, underscoring its aggressive expansion strategy. Meanwhile, Tesla's financing activities reflected a mix of debt repayments and equity issuances, highlighting its dynamic approach to balancing growth and financial stability. Analyzing cash flow statements also involves understanding non-cash activities and their impact. Non-cash activities, such as depreciation and amortization, affect net income but do not involve actual cash transactions. These items are added back to net income in the operating activities section to reconcile the difference between net income and cash flow from operations. This adjustment ensures that the cash flow statement accurately reflects the company's cash-generating ability. Additionally, changes in working capital components, such as accounts receivable, inventory, and accounts payable, can significantly impact cash flow from operations. An increase in accounts receivable indicates that sales have not yet been converted into cash, reducing operating cash flow. Conversely, an increase in accounts payable suggests that the company is deferring its payments, thereby conserving cash. Monitoring these changes helps assess the company's efficiency in managing its short-term assets and liabilities. In conclusion, mastering the analysis of cash flow statements is essential for effective business strategy and cash flow management. By examining the operating, investing, and financing activities and computing key cash flow ratios, business leaders can gain valuable insights into a company's financial health, operational efficiency, and strategic direction. Real-world examples from companies like Apple and Tesla illustrate the practical application of these concepts, highlighting the importance of a comprehensive and detailed approach to cash flow analysis. Ultimately, this knowledge empowers decision-makers to optimize resource allocation, enhance financial performance, and drive sustainable growth. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.